I think this is going to be our setup for today. Background's not as well as it should be. So thanks for joining us, everybody, and welcome to today's webinar. With a slightly different location, so it's quite interesting. There's a door behind me, so hopefully nobody will come in, and we'll see what we can do. Got another plan. Okay, now we're ready to go. I'm not at my usual location, and this slightly different location could present all sorts of issues if somebody comes in, but we will see. So welcome to this live webinar. Today we're looking at tax and domicile for UK expats in particular. We're thinking about expats that are living and working in the UK and UK expats that are living and working abroad, and what the impact of domicile is on their tax status. So your residency is different to your tax residency, and your domicile is different to your tax residency and your residency as well, but it's also different to your citizenship. So as an expat, you could have a dual citizenship, but that doesn't necessarily mean that your domicile is one or the other. So we need to have a look at that and consider those options in terms of what is the impact on your tax position. You can only have one domicile at any one time. So you're either domiciled in the UK or you're domiciled in another country. You cannot be domiciled in two countries at one time. And the essence of that is to do with the long-term tax implications. Effectively, your country of domicile have got a right to tax you on your worldwide earnings for capital and gains and inheritance, and that will be lost unless you've got a tax residency in another country with a double taxation treaty between you. So let's have a look at what domicile means. Essentially, domicile is defined as your domicile of origin. So what is your domicile as origin? It's essentially we're talking about international common law here. Your domicile is the country in which you're born and which your father permanently lives. So again, that can cause some discretion. But if you think about who your father is, where he's domiciled from, that would generally be your domicile. So you could be born abroad with a father who has a domicile of a different country, and you will adopt the domicile of his country rather than um, uh, uh, where you're born as an expat at that time. Um, a domicile is a permanent residence, as well as somewhere that you're from. So a long-term expat, as we'll see later in this talk, could change their domicile. But for domicile of origin, an expat um, can have a child abroad, and that child can still have the father's domicile from their home country. If you're not married, then a child will acquire the domicile of the mother. So the father is the only determines the domicile if it's a married couple, and if not, it's the mother's domicile. And to change that, there must be a permanent change in your residency, or a permanent indefinite intention to remain abroad. And again, as we'll see later, you can't leave a country and change a domicile immediately. But making that a permanent home abroad and an intention to remain indefinitely abroad is the first step towards changing a domicile going forward. Expats, a UK expat living and working in any other country other than the UK is not domiciled to that country, so therefore they have the advantages of domicile rules in that country of tax residency. The second type of domicile is that of dependency. So if you're, for example, a minor, you will acquire the domicile of your legal dependent. So it's a similar sort of situation with parentage, really. So if you've got a dependence, then that can define your domicile. For people that were married before 1974, a woman would automatically acquire the domicile of her husband, but not since 1974. And that could have a big impact, for example, on tax residency. So before 1974, people could acquire a US with a US domicile would have an issue where they would still retain an element of US domicile for that UK tax residence, and that has implications back in the USA. To change that domicile of dependency, you would need to become an adult. And once you become an adult, it's the same method of changing your domicile as with your domicile of origin, that you need to permanently relocate to a new jurisdiction, have an intention to indefinitely remain there. Again, that's not as simple, but if you are brought up and educated in a country and then carry on living and working there, then by de facto, after 20 years of living in that country, that is your country of domicile. So to choose another domicile, then once you're at adult age, you have to have a permanent residency in another country with an intention to remain there. Now, as we'll see later on, that you can't do that in an instant, and it can take up to 20 years to do that, depending upon the different rules of domicile and complexity. So leaving the UK today or coming to the UK today doesn't lose your domicile tie to the home country. And for UK expats relocating abroad, one example would be inheritance tax, which is defined by your domicile. So you have a worldwide liability to inheritance tax as a UK expat, as long as you are a UK domicile by origin. So unless you choose to change your domicile, you're going to remain liable to UK inheritance tax, even though you're an expat living and working abroad. So there's changes there that PROEC can help with us find out more at our website at projectpartnership.com, or you can follow us on YouTube, subscribe to our Project Partnership channel for living and working abroad, and look at in a deeper depth at some of the issues that we've got on inheritance tax and long-term capital protection for family and business. We've got a series that's running throughout this month where we look at other issues connected with domicile and residency and the impact on family and business. So go along to our YouTube channel, subscribe, and never miss an episode, and catch up on the other stuff. So what we've said so far is that you've got a domicile of origin or dependency, and you can change that when you're an adult, but you have to relocate as an expat and long term. The UK authorities can deem you domicile no matter what you think or what you wish for. So it's not a simple matter of automatically trying to change your domicile. You can be deemed domicile in the UK or whatever. So if you've got a tax return in the UK, either as a UK expat or as an expat in the UK, you'll be deemed domicile in the UK. If your domicile of origin is in the UK and you've been tax resident for the last 2 years, so unless while you've been in the UK in the last 2 years, you will automatically be deemed domicile in the UK. You can't avoid that by changing. If you've been on the reverse side, if you've been a UK tax resident for 15 out of the last 20 years, and you're tax resident in the last 2 or 3 tax years in the UK, again you will be deemed domicile. So if you're not, if you come to the UK as an expat and you've been in the UK for 15 out of 20 years as a tax resident, then the UK will automatically deem you to be domicile, and that will affect your tax status again, as we'll see later in terms of that. And that gives you some indication of what it takes to change a domicile. Under international law, domicile change is looked at over 20 years. And if you're tax resident for 17 out of 20 years in another country, then you're likely to form, because you can choose a domicile of that new country. The UK deem your domicile after 5 years, 15 years anyway, but that domicile of choice can be made up to 17 years. So that's something to consider in terms of the impact, in terms of inheritance tax, capital gains, and worldwide tax planning. So let's now look at some of the tax saving opportunities for non-domicile and domicile expats. The tax savings options remain around. If you've got the right type of domicile for a jurisdiction, you can look to be taxed on a remittance basis, or as a nondom, or mitigate inheritance tax. Each of those are slightly different, and different countries offer those tax saving opportunities. So some countries might offer tax advantages on your tax based upon your tax residency, but not on the tax domicile. So you can have a very efficient tax residency overseas, but still be liable to inheritance taxes at your home country. Other countries offer non-domicile status, which can give you certain protections against income, but not necessarily capital. So choosing to change domicile in the long term can be a good long-term tax planning if you have lived and worked abroad in the very long term. So let's have a look at that. With the UK, you can adopt a non-domicile status, but again, as we talked before, your tax residence is the first thing, and we talk often in our other YouTube Project Partnership Living and Working Abroad videos about tax residency and how residency is not tax residency, and you could have an option to dual residency, but still you're going to be domiciled. But if you're non-domicile, you can choose to be taxed on a remittance basis. Now, during the first 7 years, that can be a very tax efficient way of working. So if you come to the UK and you're non-domicile, and there's a potential to work on a non-remittance basis. After 7 years, there's a remittance basis charge. It's an automatic charge of 30,000 that's paid if you've been tax resident for 7 out of the previous 9 years. If you've been tax resident for 12 out of 14 years, then that tax remittance charge goes up to 60,000 a year. So it's a flat rate charge, but then you're not taxed on your worldwide income and gains. You have to report it in your UK tax return as a UK tax resident. As a non-dom, there's a limit to the amount of tax that you can pay. And obviously with high rate taxes at 45% and dividend taxes on top of that, there could be quite a large tax saving available for individuals there. Looking at some other jurisdictions, let's consider non-domicile status in Cyprus. Now, Cyprus offer expats a non-domicile status. So taking this 17 out of 20 years, you can be registered as non-domicile in Cyprus. That allows an expat to enjoy 0% tax on dividends and gains over that period while they're non-domicile. So that's up to 17 years, but it's 17 tax years out of 20 that you can have. So if you're working from your personal service company receiving a large dividend income, then you'll pay no tax from that. Even if that company is abroad, because your dividends are movable income. So if you're a tax resident in Cyprus and non-dom, the dividends you receive, wherever that company is based, are going to be taxed at 0% under the double taxation treaty. The other advantage for remote working as a Cyprus non-dom is that you've got a 60-day tax rule. And if you meet the 60-day tax rule, you only have to be resident in country for 60 days. So someone enjoys moving about and wants to work in different locations, you only have to be in Cyprus for 60 days a year to enjoy your a tax residency in Cyprus and a non-dom status, which gives you the tax benefits of dividends and interest savings over that period of time. The other advantage of a Cyprus is that for new employees working in a company in Cyprus, again, there's long-term tax savings of 50% or up to 50% of income tax. So you could be paying a maximum income tax rate of 17.5% for 17 years and 0% on dividends. So there are some potential advantages there, because at the end of that period, you can then choose Cyprus as a domicile, and Cyprus has a 0% inheritance tax. So if you're a Cyprus domicile, your worldwide inheritance tax liability is 0%. Let's go along and let's have a look at some other jurisdictions just to compare the option of tax residency and managing domicile. What we said earlier was that for the first 7 years, you're tied in by your expat tax residency status, and it gives you a tie to your home country, and it makes it difficult for you to start pushing away from your domicile of origin. But if you have a permanent base and it's indefinite and is ongoing, and certainly once you get beyond 7 tax years, you can start to make a claim of a domicile of choice. It won't necessarily be valid HMRC in the UK won't make an assessment or a ruling until you've got a claim. And for inheritance tax, for example, normally you have to die. You can make a lifetime inheritance tax gift and have it tested, but essentially you can pay a lot of money to create a set of documents which verify and confirm your domicile of choice before the 20 years is up. And that can work. But there are other ways you can take action sooner to gift and protect your assets within trusts or companies to protect those assets. So with Portugal, you can register as a non-resident scheme, and there you don't pay any tax on your worldwide income. So it's different, but it's similar to Cyprus in terms of you're paying no tax on your worldwide dividends and income, only on a flat rate on your Portuguese income. But it doesn't. If you look at UAE, again, you've got a situation where it's managing your tax, but it's not giving you that non-domicile status and choice of using those options. So that slightly different residency options that can manage your domicile in a different way and manage your tax residency in a different way. So consider what regime works best for you. Where do you want to create your long-term permanent residence, and what advantage does it give you on inheritance tax over that period of time? So in summary, what we've said is that your domicile is not the same as your tax residency or your residency, and it's not the same as your citizenship or your nationality. You can be dual residents, but you can only have one domicile, and that domicile follows you around. So while you're in another jurisdiction, you're not necessarily protected from the capital and worldwide tax liabilities that you may attain by your country of domicile. Expats living and working in the UK can use non-domicile status to be taxed on a remittance basis only, but as they stay in the UK longer, over 7 tax years out of 9, a remittance charge becomes